Good afternoon, Wealth Our Way Nation. What is going on? It is your man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is, as y'all know, wealth is not only for the wealthy. I want to welcome everyone here to episode 29, the wrap up of Roth 101, Roth IRA 101. We've been covering the Roth IRA all week, and today we are wrapping up the tutorial on all things Roth IRA. I want to thank each and every one of you who are live with me as we broadcast upon our Wealth Our Way Facebook and YouTube pages. As always, a special salute and shout out to the Wealth Our Way Nation members who watch this program pre-recorded overnight, over the weekend, or wherever they can squeeze 15 minutes of financial literacy in. And last but not least, a heartfelt how you doing to my good people on the Life 101 platform who listen to the audio of this recorded program. As you can see, Big Tank is mobile today. I'm recording from, I'm in Fort Lee, New Jersey, outside of my gym. I have a 1 o'clock session with my trainer, the Fit King. This boy be in here acting like I'm not super morbidly obese and, like he got defibrillators or something on the wall in case I go into cardiac arrest. Let's hope that does not happen. I try to tell him we got to ease Big Tank into the program. He not hearing none of that. He pushed the bull right into 30 feet, and I'm in there responding and grinding. So, wish me well there. One of the things that we didn't get a chance to talk about yesterday, I keep mentioning it, and I want to start today so I don't overlook it, is the Savers Credit. The Savers Credit is something that's offered by the IRS to encourage those people fresh out of the home, basically. So it's for a younger demographic and a lower income demographic. And this could apply to some of you who are watching the program. This could apply to your siblings, your friends, your network, your kids. So I think it's important to cover here. You get a percentage of what you save as a credit on your tax return. So the limit is up to $2,000 of savings. You can get up to 50% depending on what your income phase out is. And I tell you guys all the times when it comes to numbers, y'all know Big Tank's motto is you got to go to irs.gov or another reliable source to check the numbers that pertain to you given your income level. But it's 50% up to $2,000. So giving you the top math that it could possibly be, you could get $1,000 tax credit. So think about this. A credit is different than a deduction. A deduction means we're taking money off of your income and then we're taxing that newly adjusted income. A credit means we figure out what your tax bill is and we apply this credit against it. That's a dramatic reduction. So that's an added bonus to savings. Please look up the Savers Credit on irs.gov. Yesterday, we covered converting traditional IRAs to Roth IRAs. It is a great tool to use. The last part of the conversion that I covered was the pro rata rule for people who do backdoor Roth IRA contributions. I had to I feel as though I rushed through the end of that. So I want to go over it again at the beginning of today's program, just to cover the pro rata rule. It is very important for a lot of my clients because my clients, I encourage them to do Roth IRA conversions. And the reason being is they make too much money. A good many of my clients do make too much money to contribute to a Roth IRA straight up. So let's talk about what the backdoor IRA is, and then let's talk about the pro rata rule. A backdoor IRA, backdoor Roth IRA, is when you decide to fund what is known as a traditional IRA. And a traditional IRA, because it gives you the ability to report that you put this money in an IRA and get a deduction on your income at the end of the year, you also have the choice to not report the income as a deduction. That is called a non-deductible IRA. So here's what I do. I open a traditional IRA. I put $7,000 in because I'm over the age of 50. I don't choose to deduct it. I keep it as a non-deductible IRA. The minute that money is showing up in my IRA, sometimes it takes a day, 2 days to transfer in, I open a Roth IRA. Sometimes I open the Roth IRA the same day as the traditional just for timing's sake. And then I convert the traditional IRA funds into a Roth IRA. When you're doing it so fast, no interest has gained on the money. So the entire $7,000 that I put into the traditional IRA will go into the Roth IRA, and I will owe zero in taxes. Now I've successfully made a Roth IRA contribution despite the fact that my income exceeds the Roth IRA contribution limit, income limits. Now, why am I going over this again and so slowly? Because in the example that I just gave you, the only IRAs that we are dealing with is the traditional non-deductible IRA that I opened and subsequently converted to a Roth. But what happens if I am sitting on an IRA somewhere that used to be an old employer's 401k that I rolled over, and I have it sitting and I'm not touching that one? I'm not converting any of that. How does the IRS look at these transactions now? This is where the pro rata rule rears its ugly head. So what the IRS says is, look, you want to convert this $7,000 that you just put into a non-deductible IRA. Those funds are considered untaxed. I'm sorry. Those funds are considered taxed because you took $7,000 out of your bank account that got there after being taxed. You put it into a traditional IRA, and now you want to roll it over. Those are taxed funds. However, you're sitting with a larger IRA somewhere that has pre-taxed funds in it. So I'm going to walk you through the example very slow. We may spend the whole program on this. I worked at a job. I was contributing money to my 401k. We all know that those contributions are pre-tax dollars. Those are monies that go into my 401k before the IRS sees it and taxes it. So any money that's in that 401k is pre-tax. I leave that job. I take that 401k and I roll it into an IRA. It's still pre-tax money. It's sitting in an account that is pre-taxed. So now I decide to open up this smaller non-deductible IRA for the purpose of doing a backdoor Roth. What the government says is, let's take a look at that bigger IRA that you got sitting over there with all that pre-tax money in it, and we're going to add the two figures together. So to keep the math clean, let's say that if I'm doing $7,000 in the new IRA, I just happen to have $93,000 in the other pre-tax IRA. 93 and 7 is $100,000. What I am being shown as converting is 7%, 7,000. The government says I have to look at that 7,000 and I have to include 93% of it as pre-tax income and pay tax on it. It's a little unfair. But what they're doing is they're preventing people from converting money that was not taxed and never paying tax on it. So even though in this instance, I'm being quote unquote double taxed, I paid the tax on the 7,000. Now I have to include 6,300 of it, or a little bit more than 6,300 of it as income. I will now never have to pay tax on the $7,000. If that doesn't make sense to anybody, you can post in the comments. I can address your question. If not, I'm going to move on to what the distributions look like, what some of the rules are in retirement, and how a Roth IRA has added benefits for when you pass away and leave money to your heirs, unlike a traditional IRA. When you pass away, one of the most inefficient, heavily taxed items to die with is a traditional IRA. Because your heirs are taxed at their income tax rate when they pass, coupled with the fact that they're forced to take that. I don't know what's going on with my internet. My car just turned off. Let me turn it back on so I can make sure that I have connection to the Wi-Fi. So because of that, it makes a lot of sense for you to want to get into a Roth IRA. Because a Roth IRA is never taxed, it's not taxable to your heirs either. And as a result of it not being taxable to your heirs, it doesn't really matter at what pace they take the money out. Because if you take a large sum of money out from an IRA and it gets included in your regular income, you're not just paying tax on that money, you could be raising your overall tax bracket on the other income that you earned. And that will make you have a higher tax bill across the board in retirement, or make your heirs have a higher tax bracket across the board. You do not want that to happen. Another thing is, and we touched on this the other day, about required minimum distributions. A required minimum distribution is something that you are made to take from your IRA. Now, here's what's funny. Everybody knows I grew up poor. I didn't have big man money problems when I was younger. And when I first got into financial services and was taught what the RMDs are, I thought that that was the stupidest rule possible. I didn't think it was an issue, because I said to myself, I'm funding my retirement so I can use my retirement money. The government's not going to have to make me take no required minimum distributions. I'm going to take my own money out because I need it. What I learned is that successful financial people who are planning ahead of time, they end up utilizing their IRAs because they're tax efficient, but they have other monies that they can live off in retirement. And they want the money that's tax free or tax deferred to keep growing for as long as possible. And as a result, they don't want to take the money out. Some of them want to leave the money in until they die and give it to their heirs tax free. That's why the government has an RMD rule. They're like, yo, we need to tax this money eventually. And whether you want to or not, we are going to require you to take minimum distributions every year. And they base it on your life expectancy under a couple of different actuarial charts that you can find on irs.gov. With that being said, if you end up with a conversion or funding a Roth IRA from the very beginning, RMDs never come into play, because first of all, you're not going to be taxed on any amount that you take out. And second of all, you don't have to stop contributing to your IRA even after age 70 and a half. And I believe because of the Secure Act, they've pushed that age back to 72. So you can literally keep stacking money inside of a Roth IRA even after you've retired from your main job, so long as what? I hope somebody can answer it for me, but I'm going to answer it because I got to be brief. So long as you're making earned income. You always need earned income to contribute to any kind of individual retirement account, a Roth or a traditional. So if you happen to be retired from your full-time job, but you still do some type of consulting, or you have a small business, when you are retired, you can take your earned income and continue to stack it inside of your Roth IRA, and that money will grow without income tax. I started this week talking about the Roth IRA and explaining to you about how Peter Thiel had put some of his PayPal investment inside of a Roth IRA, and now it's worth $5 billion that he will never pay tax on. And how the Senate and Congress and the rest of the government, the IRS, the other agencies see that as an abuse of what they intended. Here's what I have to say, and this will be my last rant as we get ready for the weekend. Great for Peter Thiel. You know, I'm all for it, minimizing my taxes. We have an obligation to pay tax. We do not have an obligation to pay more tax than is required. With that being said, the middle class gets the shaft all the time when it comes to all of this stuff. Wealthy people, they take advantage of things. They know how to take advantage of things. Poor people, they're in survival mode, so they're not even thinking about putting money away to save. It's us. It's me and you making between $80,000 and $500,000. That's considered the middle class. Making the money and being subject to all of these different limitations and rules. We have to make sure that we are challenging our elected officials to protect the middle class. The rich will be fine. The poor has government subsidies and other things. And just be quite honest with you, I'll speak frankly as a person who grew up poor. This stuff kind of just goes over the poorest head in a lot of instances. If you're in a survival mode, you'll pretty much stay in a survival mode until you do something to break the cycle. But it's those of us who have pulled ourselves up by our bootstrap and climbed the ladder that get shut down by these limitations. So I need you guys to be diligent and vigilant. I don't know if vigilant in making sure that you challenge the status quo to make sure you can contribute as much as possible for a safe and healthy retirement. With that being said, it's a beautiful day. I hope to get my motorcycle back today. She's in the shop getting some fuel treatment because she was stalling in first gear. I want you guys to have a great weekend. And remember at Wealth Our Way what our motto is. Wealth is not only for the wealthy. Take care.